Hey there, folks. So, let's talk about Warren Buffett and his recent move that's got everyone buzzing. Yep, he just sold a whopping 13% of his Apple shares. Now, if you're like me, you're probably wondering, what's the deal here? Is Buffett falling out of love with Apple, or is there more to the story? Well, hold your horses, because things aren't always black and white. See, life's a bit like a mixed bag of goodies, and this situation is no different. Sure, part of it might have to do with Apple, but there's more to it than meets the eye. First off, let's not forget that, even after selling off a chunk of his Apple stash, it's still Buffett's biggest holding, clocking in at a whopping $140 billion. That's not chump change, folks. Now, there's this old saying that goes, there's only one reason to buy, but 1,000 reasons to sell. And boy, does it fit like a glove here. Buffett's not just trimming the hedges anymore, he's taking out the lawnmower. During a recent shareholders meeting, Buffett spilled the beans. He basically said, look folks, this ain't personal, it's just business. He needed cash for two main reasons, taxes and predictions. First up, taxes. Nobody likes them, but hey, they're a fact of life. Buffett had to cough up some serious dough for taxable gains, and with Uncle Sam eyeing his wallet, he figured it's better to pay up now while the tax rates are low, rather than risk getting hit harder down the road. But here's the kicker. Buffett also thinks Uncle Sam's gonna raise corporate taxes come 2025. With the national debt ballooning faster than a hot air balloon, someone's gotta foot the bill, and who better than big corporations, right? So when you boil it all down, it's not just about Apple, it's about Buffett playing the tax game and making some savvy predictions. After all, even the Oracle of Omaha needs to balance his books. Let's get one thing straight. This isn't about bashing Apple or singing its praises. Investing is a wild ride, full of twists and turns, and this move by Buffett is no exception. It's all about the nuances, my friends. So let's break it down. Buffett's been making headlines lately for dumping about 13% of his Apple shares. Yep, that's a big chunk. But why Apple specifically? Well, that's the million-dollar question. If we take a peek at the recent shareholders meeting of Berkshire Hathaway, it's clear that this Apple sell-off is the talk of the town. And rightly so. I mean, when one of the biggest players in the game makes a move like this, people take notice. Now, Buffett isn't new to the game of selling off stocks. He's been known to trim his portfolio here and there, but this time, it's different. This time, it's 13%. So, what gives? Well, let's take a look at the numbers. Over the past few months, Apple's stock has been on a bit of a roller coaster. It's down a smidge over the last 3 months, but up around 9.5% over the past year. Not too shabby, right? But here's the thing, there's more than one reason to sell a stock. Taxes, market trends, you name it. It's like that old saying goes, people have only one reason to buy a stock, but 1,000 reasons to sell one. And let me tell you, it's spot on. So, while we can't read Buffett's mind, we can make some educated guesses. Maybe it's about taxes, maybe it's about shifting market dynamics, or maybe, just maybe, it's a bit of both. Let's talk numbers. Buffett's got a hefty chunk of Apple stock, to the tune of $140 billion. That's no small potatoes, folks. And trust me, he's not about to dump it all in one go. So, why the sell-off? According to the man himself, it's all about taxes. Yep, Uncle Sam's come knocking, and Buffett needs some cash to foot the bill. Plus, he's got a hunch that corporate taxes might be on the rise soon. So, it's a case of cashing in while the going's good. But here's the kicker. When you've got profits coming out the wazoo, like Buffett does, it's only natural to consider trimming the fat. And that's exactly what he's doing. Now, you might be wondering, why Apple? Well, my friend, that's where things get interesting. See, Buffett's sitting on a mountain of profits with Apple. His cost basis, way back in the 30s. And now, well, let's just say he's swimming in cash. So when it comes to trimming the portfolio, Apple's a prime candidate. But here's the thing, it's not just about the money. There are some issues bubbling under the surface at Apple, and Buffett's not blind to them. So what's the deal with Apple's future? Well, according to Buffett, it's looking bright. He's confident that Apple will remain his top dog, even into 2024. So, no, he's not planning to ditch the company anytime soon. But hold your horses, because there are a couple of bumps in the road. Now, let's talk numbers. Apple's been crushing it, no doubt about it. With $380 billion in revenue and $100 billion in income over the past 5 years, they're sitting pretty. But here's the kicker. While the numbers look good overall, there are a couple of red flags waving in the breeze. First off, the growth rate. It's been slowing down, dropping by 1% over the past year, and when you're up against competitors who are sprinting ahead, that's not exactly great news. Secondly, let's talk PE ratios. Apple's sitting at a forward PE of 28 and a current PE of 27.6. Translation, they're trading at a pretty penny, especially compared to competitors who are outpacing them in growth and outlook. But don't just take my word for it, let's take a look at the competition. If we compare Apple to the likes of Meta and Google, the numbers speak for themselves. Meta's revenue is soaring at 21% growth, while Google's not far behind at 11.7%. Meanwhile, Apple's growth? Well, let's just say it's not exactly setting the world on fire. So while Apple might be a solid bet for the long haul, there are a couple of cracks in the armor that Buffett just couldn't ignore. And hey, that's just the name of the game. When we look at the operating income, net income, and free cash flow, Apple's not exactly leading the pack. In fact, they're bringing up the rear in every category. Ouch. Now let's talk ratios. When we compare Apple to Meta and Google, things get interesting. Meta's got a price-to-sales ratio of 6.5, while Google's sitting at 7.4. And Apple? Well, they're the most expensive of the bunch, clocking in at a hefty 7.4. But wait, there's more. When we look at PE ratios, Apple's once again playing second fiddle. Google's sitting pretty at 22, while Meta's at 19. And Apple? Well, they're leading the pack at 27.6. So what's the verdict? Well, Apple's a solid business, no doubt about it, but when it comes to value for money, they're falling short. They're priced higher than their competitors, without the same growth or cash flow to back it up. So if you're a savvy investor, you might want to think twice before jumping on the Apple bandwagon. Sure, they've got a lot going for them, but when it comes to getting the most bang for your buck, there might be better options out there. So what's the bottom line with Warren Buffett and Apple? Well, it's pretty straightforward. Buffett still has a soft spot for Apple, no doubt about it. The fundamentals are solid, but here's the kicker. At its current growth rate, and without a clear plan for integrating AI into its business, Apple's trading at a premium. Now, if I were in Buffett's shoes, sitting on 4.5 times my initial investment, I'd be thinking it's time to trim the fat. And guess what? That's exactly what Buffett's doing. It's not a sign that Apple's going down the tubes, it's just the smart move to make at this point in the game. If you're interested in learning more about investing in Warren Buffett's way, don't forget to subscribe on our channel. In conclusion, folks, the tale of Warren Buffett and Apple is a lesson in savvy investing. While Buffett's love for Apple remains strong, he's not afraid to trim the sails when the winds of opportunity shift. Remember, investing isn't just about buying low and selling high, it's about knowing when to strike while the iron's hot. So, whether you're eyeing up Apple or scouting out your next big move, remember to keep your wits about you. And hey, if you want to stay ahead of the curve, don't forget to check out Stock MVP and join the Academy. Together, we'll navigate the choppy waters of the market and come out on top. Thanks for watching, and until next time, happy investing.